What's up, everybody? You got Evan Knowles and Logan Jones here at the Mill Tech Podcast. It's a good time to buy some stocks right now.
It is. Market's way down.
Yeah.
This is an opportunity.
Yeah. You watching anybody in specifically?
I've been wanting to get to diversify my portfolio a little bit. I'm big in on the tech, mostly because of you, honestly. You've given me some cool picks that I've looked into. I'll let you get into that part of it. But I bought an ETF in the energy sector just because of the way oil's been reacting lately. And then also bought what's the word I'm looking for? The one that traces the
index.
Market. Yeah, I bought an index fund that just tracks the S&P 500. Pretty boring stuff, but with the market down like this, I could see that going up pretty quickly once the market recovers.
Yeah, I think I've been buying more what I have. So, Yext obviously is an obvious one for me.
Yeah,
Livongo is one I really like. So they're building what's called applied health signals, which combines like all of your wearables along with some of their proprietary technology, puts all of those data points into their algorithms and their artificial intelligence, basically feeds you back feedback that you can use to improve your health. And then they have like telehealth doctors connected to this artificial intelligence, which is like this whole ecosystem of health. Really cool company. And then the Square of South America called Stone Co. So Berkshire Hathaway has a big portion of them.
Nice.
IPO'd last year or the year before, growing pretty steadily. But I mean, everybody's getting knocked back a lot. So perfect time to buy some good.
Before we get into talking about this episode that we just recorded, do you want to talk a little bit about who's picked up some of your stock picks in the past and why our listeners should pay attention?
Sure. So my biggest pick, and the one I've been following for about 2 years now, is called Yext. I mentioned it earlier. I have been talking about them on Twitter, and I've read articles about them. I've just been digging deep, into that company because I think they're building, the future of a big portion of the future of the internet. So they're building a technology that's called Search Experience Cloud or Digital Knowledge Management. So whenever you ask Alexa a question like how many calories are in my Big Mac, the answer is going to be provided by Yext, not Alexa or not Google. So McDonald's puts those answers into Yext, and then Yext pushes those out into the world.
Nice.
So no matter where a consumer asks a question about, McDonald's, they're going to get an answer that's correct, and McDonald's put that answer there.
Yeah, I was mostly wanting the answer about how the Motley Fool guy.
Yeah. So Motley Fool is one of the better known blogs, one of the better known resources in the financial space for innovation, and one of their head innovative reporters saw my article, gave me a shout out, and then that's his stock of the year.
Yeah, I think that's pretty cool. So
yeah, I'm excited.
Give yourself
about
a pat on the back for
that. Yeah. He credited me for finding that, which is cool.
Yeah. So who do we just get done interviewing?
So we talked with John Willmoth. John, I knew him from E-Town. So John's from E-Town. He knew my dad, and his dad was actually the mayor of E-Town. So I hit him up on LinkedIn, said, hey, let's get some dinner. We've got these common connections. I'm in the tech space. He's a venture capitalist in Louisville. I think he actually has the biggest fund in Kentucky. He just closed a fund of $22 million. And he's got an amazing background. So early in investment banking in his career, then helped build and scale a company called Nextel. I'm sure a lot of people are familiar with Nextel, cell phone provider or self-service provider, merged with Sprint for billions and billions of dollars. And he got there when they only had a few $1 million of revenue, and they had billions and billions of dollar revenue when they merged. So he was a big part of that. And then he left there and came back to Kentucky and started Poplar Ventures. So he's been helping fund companies in this area for several years now, and has had a lot of success. So we're going to walk through with him that story of Nextel, walk through the venture capital space, some of his most successful investments and why they're successful. And then for those of you that are starting a company, want to learn more about venture capital, want to learn more about venture finance, this is an awesome episode. This is probably one of the best guys in Kentucky to talk on this subject. So it's just going to be great for anybody that wants to learn about that side of the world.
Yeah, absolutely. And I think he had some different opinions than what we're used to in terms of capital.
That's true.
So I think it'll be really interesting for our listeners to not only hear what he has to say about capital in Kentucky, but why he thinks that.
Yeah.
So I think that was one of the cooler takeaways for me, just because it was so counter to what we're used to hearing.
Yeah, I mean, most of our guests, when we ask them, what can improve in Kentucky, they say we need more angel funds or seed capital. And, he has a different opinion on that. And he's going to talk about it. So,
yeah, let's go ahead and get into it then.
Let's do it. What's going on, everybody? You got Evan Knowles here with Logan Jones. We're sitting in Story, Louisville with John Willmoth, and this is going to be an awesome episode. We're really looking forward to this one. It might be a longer one, but that's fine. There's a lot to talk about here with John. He's got an awesome story, a lot of awesome experience. We want to get into all of that. So let's just start with the crazy thing that happened today, and it's been happening for a while, last few weeks, which is the market. But today was really big fall. You had some commentary, but me personally, being so young, obviously opportunity for everybody, probably. How do you look at something like this, an event like this?
Yeah, so I've been around a little while, so I've seen I think I was trying to figure out this is probably the fourth or fifth time that this type of event has occurred in the public markets. So if I go all the way back to the 1987 crash, the dot-com crash, the Great Recession, now this, and even if I go even further back, you go back to the late 70s when I was a teenager, and you had stagflation where interest rates were at 20% and inflation was through the roof.
Yeah.
Right. So, and you had gas shortages where people were standing in line at the gas station trying to get gas. So, the reality is that these things occur, and I think that the one thing that, from my perspective, is they all are a little bit different. They're never quite the same. And typically, there's some type of exogenous shock that occurs. In this case, the coronavirus is what's kind of triggering all of this mayhem right now. And then obviously you add the oil, the oil prices dropping dramatically today. So there's a lot of things going on in the market. The good news, I think, right now, and historically, if you look back, the market recovers.
Yeah.
The market is not going to just continue to go down forever. So you have to have the ability to be patient and not panic and not try to implement some type of knee-jerk reaction to what's going on in the marketplace. And I do think that the good news, again, in this particular case, the economy is actually in a pretty good position going into this. We don't have, if you go back to the 2008 time frame and the Great Recession, we had way too much debt across the board. And again, I'm not saying there won't be other things that are going to pop here, but there probably will be a few other things that there's going to be some dislocation in the market where things are going to occur that we don't, right now we don't know about. But in general, I think the economy is in a much better position than it was in 2008. And even maybe in some of those other markets. The dot-com was just, asset prices were just dramatically inflated.
Yeah.
Right. So I don't look at these as situations where you have to panic. I actually view it as, when you have adversity, there's opportunity. There always is. So if you can, from my perspective, you want to try to position yourself and be ready to take advantage of those opportunities when they come.
Yeah. You mentioned that some things that have never happened before are happening right now. What were some of those things that you've noticed that are kind of alarming, but maybe it's just the first time it's happened and it stays at that?
Well, I've never seen the 10-year treasury or the treasuries in general at the rates that they're at right now.
Yeah.
So we're at below 50 basis points on the 10-year treasury. And so when you think of, if there is one risk, I think right now, from my perspective, and again, I'm not a complete expert on the economy and the market, but the rates are so low historically. In order to be able to deal with some of these shocks, you have the Fed can interject, right? There's a combination of fiscal policy or monetary policy. The Fed on the monetary side typically can reduce interest rates. They can do other things to increase the liquidity in the marketplace to make sure that the markets are functioning. But when the rates are that low, and honestly, if you look in Europe right now, I think in the UK, the rates are actually negative, which is kind of a bizarre concept to even think about. But there are things going on here that are kind of like, okay, what do we do from a monetary policy perspective, which now leads you back to fiscal policy needs to get involved to make sure that things are stable. And all you're really looking for, you're not really trying to prop it up. You're just trying to stabilize so that the markets can kind of
normalize,
get to a point where they've kind of figured out, okay, based on everything I see, here's a level that we can land on, and then you can start building back from there.
Yeah. Well, a lot of wisdom there, and you've acquired that over a really amazing career. So let's jump into some of your early career. Jump into first off, let's start in your personal background. Where are you from? Education growing up, and then we'll get into some of your professional career.
Yeah, so I grew up in Elizabethtown, Kentucky.
That's how we connected.
Which is a great town.
Great town to be raised in. Family values, community.
Absolutely. Yeah, I know Evan because I know his father very well. His father was a few years ahead of me in high school, and phenomenal basketball player. He's one of those guys that I idolized when I was growing up because he was such a good athlete. But grew up in E-Town, had an opportunity to go to Amherst College up in Massachusetts, which was a fantastic experience. Majored in econ. And when I graduated college, I knew that I wanted to do some business oriented profession, which is why I picked econ. Even though Amherst was a liberal arts school, so I really didn't have a lot of choice. There was no business degree, there were none of that, so it was basically economics or something else. And when I graduated, I had an opportunity to go work at First Chicago in Chicago at the time, and work in a program where I was allowed to go around the bank every 6 months to a different part of the bank. I was, and they paid for my business school, so I went to the University of Chicago Business School at night, full time job, and at business school at night right out of undergrad. And I was, quite frankly, when I graduated the University of Chicago Business School, I was ready to be done with school.
I'm sure. Yeah,
I'd had enough of that. But tremendous experience in terms of being able to kind of early in my career just learn a little bit about what goes on in the economy, banking, in general. And obviously get a very good education at the University of Chicago. So that was a great first starting point for me.
When we got coffee, you had mentioned that you had insights into some really unique and big deals at the time. The way that they were structuring those deals. You had mentioned RJR Nabisco. Was that one of them? So talk about why that was unique and why that was such a good experience, and how that kind of leads into some other parts of your story.
Yeah, so when I was at First Chicago, again, moving around different parts of the bank, I pretty quickly gravitated toward what I would call equity, the equity side. So I was working in an early stage venture group, a fund to funds group that was doing investing in venture capital funds. I worked in a mezzanine capital group, which was a combination of mezzanine, subordinated debt and equity transactions. And then the last group I worked in there was what at the time was called First Chicago Equity. It's now a company called Madison Dearborn Partners, which is one of the larger private equity groups in the country. And when I was working in that particular group, this is in the late 80s, so probably in the 1980, 88, 89 timeframe. Again, I'm going to act like an old man on this whole podcast, but if you go back to that time frame, there was a wave of leverage buyouts. At that point in time, a lot of companies, well-known companies, very successful companies, you had a lot of financial companies or private equity companies start to try to buy those companies out. And you would do it with a combination of debt and equity, and they would lever up the balance sheet, bring in some equity, buy the company, and then obviously grow those businesses, pay down the debt, and then that's how you make a return on your equity. So there was a series of LBOs going on at the time, leverage buyouts, and one of the biggest deals. And if you've never watched Barbarians at the Gate. Okay, so it was a book that was written about this particular deal. So this was KKR, which is Kohlberg Kravis Roberts, which was one of the biggest private equity groups, buying RJR Nabisco. RJR Nabisco, the RJR part was the tobacco, the Nabisco obviously is the food part, but it was a big conglomerate, big consumer goods company at the time. And KKR came along and bought it for $25 billion. So when I was, and so my connection to that, I didn't work for KKR, but I was working for First Chicago Equity. They had a relationship with KKR, and because of the size of the deal, they literally had to go around and pull in other equity players to participate, to be able to have enough capital to be able to do the deal. First Chicago Equity ended up participating in that, and I had the opportunity to write the investment memo for that deal. Yeah. So right in the middle of what was, you really need to go back and watch the movie. It's an HBO movie, Barbarians at the Gate. It's fascinating.
Yeah,
and it was fascinating at the time what was going on. Didn't turn out to be a very good deal, but
why was tobacco and consumer food together in the first place?
It's a good question. I guess, go to market. If you think about those companies, they're selling through stores, grocery chains, et cetera. So they had kind of merged over a period of time.
Yeah, got it. And so that experience, getting that insight into those kind of mergers and those structures of deals, then perfectly leads into what you did next when you left there. And we're gonna spend some time on this part of the story. Because I think majority of people will probably be familiar with Nextel, and Sprint. So you were at Nextel super early, and you were a big part of growing that into what it became, and eventually when it merged. So let's dig into that, and we'll spend some time on this because it's just a really crazy story. So start wherever you think it's best to start on that part of your journey.
Yeah, well, I guess I'll start at First Chicago because that's where I got to know the company. Mm-hmm. So the First Chicago Equity Group that I was in, they had made an investment in a little company called Fleet Call, which became Nextel. Okay. A few years later, we changed our name, but they had made an investment to basically buy Spectrum FCC licenses and to kind of aggregate that license position and become effectively the third cellular network. So let me. And the reason I got connected with them is because I was working at First Chicago. They had made the investment. I got to know the founders. And eventually they said, hey, we need some help doing these acquisitions. We're buying these little companies. Would you want to come on and do that? So that's kind of how I got there. But let me back up and explain what Nextel was, really how it was formed. Yeah. So the founder, there are a couple of co-founders, but the principal founder, a gentleman by the name of Morgan O'Brien, a fantastic guy, FCC lawyer. And he understood at the time, you got to go back again, I'm going to be old man here, late 80s, cell phones really didn't exist, right? So they were just coming onto the scene. The FCC had allocated 2 licenses in each market around the country, kind of an incumbent telco got one, and then an independent provider got the other. Mm-hmm. And so they said, go to market. Offer cellular service, phone service. And so those companies went down that path. Right next to those 2 pieces of spectrum was another piece of spectrum that was allocated for specialized mobile radio and basically fleet dispatch.
And real quick, just for those that maybe not understand the concept of the spectrum, in the shortest way you possibly can, describe what that means.
Well, spectrum means, if you have this phone, right, the signal that goes from this phone to the tower to be able to give you your data and be able to make your phone call, that goes over a piece of spectrum, radio spectrum, right? And in this particular case, this spectrum was in the 800 megahertz range, and that's what cell companies use to be able to deliver that information. Right. So the spectrum is basically the raw material. Right. Okay. If you don't have it, you can't deliver the service. Yeah. And so Fleet Call at the time, Nextel, had this idea, Morgan had the idea he looked at the spectrum that the cellular carriers have, and he looked at the spectrum that the specialized mobile radio carriers had, and they were divvied up into small pieces. And he said, this trades at a fraction of the cost of these licenses. What if we pulled all those back together and created effectively the third cellular license?
Yeah.
And so buy it at a discount, pull it all back together, go to the FCC, change the rules slightly to compete with those other guys, and then now all of a sudden you've turned something that was worth fraction, a penny, into something that's worth $1.
You said that's arbitrage.
Yeah, I mean, that was the original pure arbitrage. Now, once you get to that position, and I would say we did hundreds of acquisitions over a 3 or 4 year period,
and it was your job to basically
that was my primary job coming in, was to basically go do those acquisitions, and I was involved with literally hundreds of transactions and negotiating deals. And keep in mind, I was 25 when I joined, so
it's crazy.
I'm not overly experienced necessarily, but it was, we had a process, we understood what we were doing, and it was a fantastic experience, obviously, to be able to go do that.
What's the pitch to the FCC there? I mean, is the pitch that this spectrum, you said it was like basically for dispatch. What do you tell the FCC to get them to basically make this is not an exception, but to change the rule?
Well, the rule that we needed to change is that at the time that spectrum was for two-way radio dispatch.
Yeah. And
all we were really asking them to do was to change the rule to allow us to do cellular as well.
Okay.
And so it wasn't as if we were asking for a dramatic change, but until we got that approval to do that, we're kind of stuck in this mode. We were going to offer two-way radio dispatch. And obviously we knew that wasn't the future. We knew we needed to do that. So the push to talk.
Yes, yeah. I was about to say, that's what I remember.
And that is, and that's kind of the growth part of kind of how Nextel ended up being as successful as it was.
It's good marketing.
Well,
if I remember right.
If you think about it, so we got the FCC to change the rules. And if you think about the FCC, we were pro-competitive. Our pitch was, look, guys, there's 2 cellular licenses. Why can't you have a third? We'll compete. That's good, right? That's a good thing to have more competition.
Good for everybody.
Yeah, absolutely. So we were able to convince the FCC to do that. The growth of the company really came in the 90s. And what happened was Motorola actually owned a bunch of the licenses. They had been a long time leader in the specialized mobile radio market. They were, provided both the telecom equipment that, at the network layer, as well as the actual devices. So they were the dominant player in specialized mobile radio. They owned a bunch of the licenses. We ended up buying all of their licenses, and as part of that deal, we effectively said to them, okay, we'll use your technology. They developed a new technology that allowed us to do combination of paging, which is an old thing that existed.
The thing that's on your hip?
Yeah, the pager on your hip. That existed in the old days. The combination of a pager, a two-way radio, a cell phone at the time. And so putting all those capabilities together. So Motorola developed the technology. We went to market, and what we realized is, and I think this happened in Atlanta. So in Atlanta, they started taking our solution. The construction industry basically realized that they could, initially the two-way radio was just internal. Mm-hmm. So like if you were in a company, you could communicate within your own company. And then we said, well, why can't we open that up to anybody in the market? And so we eventually said, you can communicate to your company, but you can also communicate to that company, okay? And then eventually we said, well, guess what? You're in Atlanta. Why don't you want to talk to the guys out in California? We literally had a nationwide push to talk. You could be right here in Louisville, push that button, and you could get somebody in California instantly. So I would argue that it is effectively what kind of, you think about text messaging today. It was a voice text messaging functionality that was instantaneous.
That's an interesting.
And it was it was conducive to those things where the customer needed instantaneous communication.
So construction was kind of the beachhead.
And what happened was that the general contractors, when they realized they could communicate with all of their subcontractors, they basically said, guess what, guys? You're using this technology because I want to be able to talk to you guys and coordinate.
Wow.
And so you get that snowball network effect. And that basically, once we realized that that was occurring, we obviously piggybacked that across the country. And then we went into other verticals and started trying to do similar things. And that allowed us basically to carve out a niche in the market. It wasn't just basic cell phone, right? Yep. You know, if you think of this, what does a cell phone company compete on?
Like hardware or the cellular
what do you
providers?
compete on if you're a cell phone provider? The service, the network.
Yeah,
you compete on coverage, a better network, maybe better devices, right?
Yeah,
but that's it, right?
Yeah,
we had something else. We had a unique functionality that they really couldn't duplicate that served a particular market. And look, we went after businesses.
Yeah,
we weren't going after consumers. We were going after businesses. And that allowed us to grow from when I started with Nextel in late 89, we probably had, I don't know, I'm going to say somewhere south of 10 million of revenue because we were starting to buy companies that had real revenue.
Yeah.
And when we merged with Sprint in 2005, we had about 15 billion in revenue.
Wow.
So take it from that to that. Now, what I'll tell you about that whole experience, one thing personally, and then one thing as far as the company's concerned. First, on the company side, one of the biggest lessons out of Nextel, from my perspective, was that a company can make a lot of mistakes and can recover from those mistakes if you have a market that's going up and to the right.
Oh, I like this. Yeah, I like this part of the conversation we had. It was good. Yeah.
So which influences how I think about investing. It gives you degrees of freedom.
Yeah.
So do I want to be in a market that's stagnant, or do I want to be in one that's growing? And one that's growing, and particularly if it's growing at an outsized pace, that market, you can bumble along. You're still going to be able to survive and probably even prosper because people recognize the growth and they're going to be willing to continue to support you, continue to finance that business. So that was a big key lesson for me from Nextel at a very macro.
Some current examples might be, remote work's growing fast. So Slack, Zoom, those are some that are catching this larger trend, right?
Absolutely.
Yeah. Those are two examples.
That's a very good example.
Yeah.
Right. So you find markets like that, and you don't even have to always have to be the leader. Mm-hmm. You can be a fast follower.
It's going to pull you.
Yeah. Or you can just provide you can provide a piece of the solution.
Yeah.
You don't even have to be the one right out on the bleeding edge. You can be a fast follower with a part of the solution, and you just get caught up in the wave. Mm-hmm. And so I love markets like that, and I love businesses like that. And so if you can find those, I definitely want to do that. From a personal perspective, Nextel, I had tremendous opportunity. So I obviously early on I was doing a lot of the acquisition work. Later in my career, I was kind of the guy that got in the corporate development group that got the complex transactions. So we created a company called Nextel Partners, which was really just to get to the next markets that we weren't getting to. But it was literally $1 billion startup. So I had to kind of put that together along with the management team that was going to go run it. We sold our tower assets for $650 million. We did all kinds of other transactions, raised a ton of money, obviously, to be able to grow the business. So I had a lot of good experience later in my career, and this is kind of relevant to how I got to what I'm doing today. Keep in mind, I had learned a little bit about venture capital, private equity early at First Chicago. At Nextel, I became kind of also the individual inside the company that managed our private equity investments. We didn't have a dedicated group that was doing investing, but we were opportunistic. So if we identified a technology or a company in the wireless industry that we thought was interesting, might give us some type of differentiation down the road, we would make an investment in that company. Mm-hmm. I think we put in about $50 million in about 7 companies. Again, mostly technology related type of companies. But I was the person inside Nextel that was responsible for managing those investments. So I learned I got an opportunity to see the private equity venture capital space at First Chicago. I got to see the corporate venture space at Nextel, and that ultimately, when I decided to leave Nextel after we merged with Sprint, that's kind of what led me down that path.
Yeah. So next, you had that awesome experience. You probably made a good amount of money, and then you had this opportunity to go into venture capital, and you started your career. You came back to Louisville, sorry. And I'd like to ask a question: why did you come back when you had this experience everywhere? You were traveling. You had all these big markets. You probably had a lot of great connections. We always like to hear about. We call it a boomerang. You leave and come back. You leave and get amazing experience, and you bring that experience to Kentucky, and you help grow, the state. So talk about why you came back.
Why do you think I came back?
Family, the amazing scenery around here, pace of life.
Woman,
okay.
Yeah.
Yeah. See, I didn't know.
So my high school sweetheart came back to get married.
Okay.
And, she had a couple of kids, one of which
yes,
you know.
I know, Davis, yes.
I didn't want to at the time. It was, we had just merged with kind of all this timing, sometimes things just happen at the right time.
Yeah.
We had, Karen, my wife, we had been, always stayed in touch with each other. We always had that interest in each other. And I think that what ended up happening is right about the time that we merged with Sprint, and you could see the train wreck coming with that, right? So here's a big traditional telco company buying a upstart, aggressive, entrepreneurial style company.
Yeah.
Even though it was pretty big at the time, you could see that train wreck coming.
Mm-hmm.
And so I said, look, I'll hang around for a little while, but I want to go. It's time. I've been there 17 years. It's time for me to do something different. Literally right at that time frame, Karen and I are, having this conversation about possibly getting married. So that was, the timing was perfect. I literally went from, I left the day I left, either that day or that week, we got engaged. Within 6 months, I had bought a house, gotten married, and moved to Kentucky.
Nice.
So big shift.
That's a lot, yeah.
Big shift, but I'm it's been a fantastic move for me.
Yeah.
Right. I mean, obviously, got the love of my life,
yes.
and then being back in Kentucky where I grew up, that means a lot to me. And I'm not going anywhere. This is where I live. This is where I'm going to be. But that was that's why I came back.
I'm gonna have to start guessing that more because Eric with OmniLife, that was his reason to come back.
The women bring people back.
All right.
Well, we've got beautiful
first guest next time.
We've got beautiful women in Kentucky. Fast horses, beautiful women. That's what brings people back.
There you go.
That is true.
So let's get into Poplar Ventures then, or actually, you had a stint before that.
Yeah. So when I came back, I had the idea that I wanted to invest, right? So I had some of my own capital, and I wanted to invest in companies. And I think the transition for me, I'm not going to say it was easy. I'll be honest with you, because you're working in a big corporate
you got
job.
a routine. You've got
access to whatever you need access to. You're used to dealing with executives at Samsung and Qualcomm, and go down the list, and now all of a sudden you're nothing
in Kentucky.
So you're basically back to square one in a lot of respects. So that was a big transition, but I knew that I wanted to do investing. And if you think about this time frame, so this is 06, 07-ish time frame, and there was a shift going on at the time from on-premise software to cloud-based recurring revenue software. And obviously the wireless industry is a subscription-based revenue model where you have to pay attention to cost of acquisition, you have to pay attention to churn, So all of those metrics around a recurring revenue business model. And then I see software starting to move in that direction. And I'm like, I recognize that.
What year was this again?
Kind of 06, 07
Okay.
time frame.
Yeah.
So I'm like, okay, I recognize that. I like that. I understand that. So let's see if we can. It wasn't like honestly, it wasn't a conscious, I'm going to go invest in software technology. It was more of, it found me. It was like, it was a natural transition for me to go to that. And so I started investing individually, a couple of different companies. I worked with Chrysalis Ventures here in town for a decade as a venture partner, first part-time, then full-time, led a couple of investments for them, and then went back part-time. And now obviously I'm out of there and running Poplar Ventures. But good experience there, great folks over there and very capable. So a lot of good experience, but I started, gravitating very clearly toward the software technology companies. And the one in particular here locally that I invested in and went on the board was ZirMed.
Yeah, this is another story that we want to spend some time on because awesome story. But when we were talking about this yesterday, you had mentioned that, and I didn't know about it. So huge exit right here in Louisville, and I didn't know about it. And we're sitting here doing Middle Tech. It didn't happen too long ago, and so that's part of this story we're about to tell, and like why this is important with this particular company. But let's tell this story because let's go ahead.
So there's probably a lot of good stories. I came along in probably 08 time frame is when I think I first made my investment, and I got connected. Like one thing I'll tell folks is the network is the most important thing that you 100%, have, because you never know when something is going to pop out of that network, right? So the business relationships you develop, the people that you meet along the way, they're all very important. You may not think they're important at the time, but you maintain those relationships because you never know when they're going to pop up. So what ended up happening is a connection in Elizabethtown, who was on the board at ZirMed at the time, knew that I was back in town, and said, "Hey, you ought to take a look at this company." And so I went over and talked to the management team, and that led to ultimately them asking me to join the board. And I said, "Well, if you want me to join the board, then I would like to make an investment." And so at the time, the company had been basically funded. This company had been funded. It was founded, I think, in '99. It was funded pretty much passing the hat. So they literally had, 200 investors, small investors, mom and pop. And so at the time there were occasionally people would say, "Hey, I'm ready to sell. I bought in earlier. I want to exit now." So there was opportunities to buy. So that's how we ended up investing. That's how I ended up investing in the company and went on the board. So what ZirMed does, it's now a company called Waystar after a couple of transactions. But what they basically did was they helped healthcare providers get paid. It was a claims processing, a solution that allowed those providers to submit claims, where they knew that they were going to go through, where they could bill the customer appropriately, they could collect co-pays correctly. So it was really everything around getting paid, and they just drove tremendous efficiency in that process. And that's what ZirMed did. It's not brain
nothing too flashy.
It's not brain surgery. It literally, it's not brain surgery in the healthcare space, but it was a business process, and at the time was very much needed. And they had kind of grown up at serving small doctor offices, and eventually we went up market and started going after larger hospitals and bigger healthcare entities. But that company grew. I think when I first invested, it was about $20 million in revenue. It was already cash flow positive. And when we exited, we ended up, Bain Capital came along in 2017, and they had already made an investment in a company called Navicure, which was a competitor of ours. And so Bain came along and said, "Hey, I want to put these two companies together." and we ended up selling the business. We grown it from 20 million to 160 million, and in revenue, and sold it for $750 million.
Yeah.
So, the one thing I would say is that, and I mentioned this to you, the thing that was very shocking to me to a large degree is there was literally, not literally, virtually no press.
Yeah. This is what I wanted to touch
on that transaction.
Yeah.
I mean,
That's so
there was an
crazy.
announcement, right? But there was no. You would think that there would be some follow up, and people would say, "Well, how did that happen?
Yeah.
Let's hear that story. Let's understand how this company grew from nothing over a period of 20 years into a $750 million exit."
Yeah.
Right here in Louisville, Kentucky. Born and raised in Louisville, Kentucky,
With investors
So
in
that's
small town
crazy.
Elizabethtown.
Yeah, exactly. You
Yeah.
got all these little investors. So how does that happen? And let's tell that story. That's a pretty good, successful story.
Yeah.
And so I'm still, it still boggles my mind, but it is what it is, right? I mean, that's part of what we can talk more about Kentucky and Louisville and so forth, and from an investing standpoint, but that was a phenomenal transaction, a great team. The other wonderful benefit from my perspective out of that whole thing, other than working with the management team and the board, I got a chance to meet Doug Leone from Sequoia, who Sequoia ended up investing in the company, and a few years after I got in, and they, Doug came on the board, which was like, you got the guy that basically is one of the top guys at Sequoia, one of the most successful venture capital firms in the world, and all of a sudden he's on your board in Louisville, Kentucky.
Yeah.
So how does that happen?
Yeah.
I don't know. They found us. Actually, I'll tell you a good story. When he came in to pitch the company and say, "Hey, we want to invest in the company," he came in, and all he really did, he had like 2 slides. Maybe one slide, and that slide was basically just the logos of all the companies that the Sequoia had invested in, most of which everybody knows.
Right. Yeah.
Right.
Yeah.
So just
Walk in with the cloud.
That's the pitch, right?
Yeah.
So, but I would say this: Doug is, you learn something from everybody as you go along in your career, and I think the biggest thing I learned from Doug, he's a lot of fun. He's very direct in terms of how he communicates. He's usually right. Not always, but he's usually right.
Yeah.
And what I really loved about him is that he's capable as an investor. Obviously, he sees a lot of things, but he's capable as an investor to be able to adjust his thinking about a company or an investment based upon what he sees. In other words, so a lot of people kind of get a view of, hey, I like this company, this is what I see, but then maybe the metrics of the business, or it kind of evolves in a way that doesn't fit with that thesis, and people can't adjust. They have this mindset that this is what that company is supposed to be doing, as opposed to what is the market saying? Yeah. How is this company fitting in with the market, and how do you adjust to that? So he's really, really good. That's the one thing, big takeaway from my perspective, is really listening to kind of how the market is reacting to that company, and being willing to adjust, and being willing to say, hey, we got to do something different than what we're doing.
Does he ever come back this way and hang out in Kentucky? And is he involved at all still in the area?
I don't think hanging out in Kentucky is probably high on
the
his
Derby.
list.
Hey, Derby, you got the Derby, you got all kinds. You got some good reasons to come back.
Yeah,
So
well, he's. I'm sure if I invited him back, he probably wouldn't come. But I go out there to see him occasionally.
Yeah.
You mentioned kind of learning something from everyone you meet along the way. And it sounds like your experience was a great teacher for you as well. But was there ever kind of a consistent mentor or network of mentors throughout your life that kind of guided you through this process? Because, I mean, it sounds like you were really young, stepping into a lot of these really big roles and really high pressure situations.
I don't know if I wouldn't say a consistent mentor, but just folks along the way. So the first guy that I worked for at Nextel went on to become the governor of Delaware. very good friend of mine.
Yeah.
Morgan O'Brien, Brian McCauley, the original founders of Nextel, were great folks. I've had, there's plenty of other folks that I would say would fit the bill in terms of being mentors or folks that have been influential in my career, but no one in particular. And I think you just you want to leverage those as much as you can.
Yeah, absolutely.
And what I loved about that story, and I mean, we'll touch probably on this a little bit more later, but the fact that there was no press, and even all these years, well, I mean, it's only been 2 years since they exited, but still there's that problem. And that's what we noticed in the market. That's why we're here. That's why we're sitting with you. But I think that that's something still is needing to be fixed. We're helping, but there needs to be a lot more of people doing what we're doing. And the more that happens, and the more companies that grow here in Louisville, I just think it's going to get to a point that we just have to say, like, there has to be more digital media. And I keep talking about this with friends and with people in the space is, everybody's trying to throw more events or, other things in the space where you gather people together in person. But to me, I think the way that you begin to grow the ecosystem more is digital media, news, ways for people to consume this content and like stumble across it, not at an event, because that's not scalable. Events, if you're trying to grow an ecosystem, are not necessarily scalable. You have to do it in a way that people can consume it when they're in their home. Mm-hmm. People can stumble across it. So one of my big rants that I've been going on with people is like, in order to grow the ecosystem, like we just have to start doing more digital media to cover those stories, because it's the word of mouth on that story is not going to be as powerful as a podcast or a news article in the Courier Journal or something like that. So we just have to keep like harping on that concept of there's a lack of conversation around those success stories.
Yeah, I think so. I think, and look, it's not gonna happen overnight.
Yeah, no.
The issue is, and I grew up in Kentucky, so I can say this: the mindset here is not geared toward technology-based companies, right? The mindset is geared toward healthcare to a large degree. It's geared toward bourbon. Mm-hmm. It's geared toward horse racing. Mm-hmm. It's geared toward, fast food franchise. It's geared toward logistics.
Yeah.
Right. So those are the things, basketball, right? I mean, that's what people talk about. Mm-hmm. And so they don't talk about, in a business setting, they don't talk about technology-based companies.
Yeah.
Right. Now, I would say to you that if you went to Seattle 40 years ago, they didn't talk about it either. Mm-hmm. But guess what? Microsoft.
Bill Gates came along.
Yeah. Microsoft, McCaw Cellular, and from the cellular industry, was huge. They were out of Seattle. That's why T-Mobile's there, by the way. That's why their headquarters is in Seattle. You've got Amazon now.
Yeah.
You think about what they are now as a community. That didn't exist 40 years ago.
Yeah.
So you just have to. You do have to start talking about it, and you do have to get people a little bit more visibility to it. And one of the things I always say to folks is, you are a technology company.
Everyone.
I don't care what business you're in.
Yeah.
You're using software. You're communicating with these devices or some other type of devices. You're using cloud-based services. Obviously some businesses are very technology driven, but literally every company is technology based. And you need people across the board in your organization that not just the developers, but marketing and sales and all those other functions. You need people in those areas as well that are technology savvy.
Yeah.
That is where the world is going.
Yeah.
So people need to be paying attention to that and understand this is where the future is. Let's pay attention to it.
Yep. So along with, developing markets, whether it's conversation or people realizing that, they are a tech company, there's the need for capital to help the industry grow, the ecosystem grow. And we had a, good conversation yesterday because a lot of our past guests, we always ask, what's the thing that can improve around here? And a lot of them say, well, we need more capital. We need more seed capital, or we need more angel capital, whatever it might be. A lot of times what comes up is the need for capital. And you're the first person to say, no, don't buy that. Let's talk about that. So why don't you buy that? And what do you have to say to those that think we need more capital?
I like to dumb it down because I think we tend to make things more complicated than they need to be. So when I think about investing, there's really just if you're trying to build an ecosystem there's really just three things. There's the business opportunity, i.e. the idea, the business market opportunity that you're pursuing, the talent to be able to scale that business, and the capital.
Yeah.
If you think about those are the elements of what you need, right? And you can't, and it's not one or the other, it's all of them. If you really want to have something that's successful, you have to have all of those. You've got to have a real market opportunity, you have to have real talent that can build it and grow it, and you got to have access to capital. So they're all relevant. What I would tell you is, my philosophy on the market opportunity is you're looking for big, growing markets. It can be an established market if there's some type of disruptor that's going on. And I would argue that the software industry as a whole is a good example of that, right? Yeah. You went from on-premise software to cloud-based recurring revenue software. So you had a massive, big market that all of a sudden new entrants could come along and undercut the old guys because they had a new way to deliver it and they could deliver the best, newest technology, right? So there's a good example of a big growing market.
Yeah.
So part of it is when you're thinking about, when you're looking at entrepreneurs and early stage businesses, you have to pay attention to, it's okay to have an idea about a business that you want to start, but you got to think about can that be a big business? Because if it can't be a big business, then you're not going to likely attract capital to it, right? Yeah. So got to have a big market, good business opportunity, got to have talent to lead it. And talent doesn't mean, I said this to you yesterday.
I wanted you to touch
talent
on this. Does
not mean intelligence. Talent means the ability to manage that business to scale. And I think people sometimes they think talent, they get defensive. When I say we don't have an abundance of talent here to grow those types of businesses. If you go to Silicon Valley, you've got, think of the three things I mentioned. You've got market opportunity, you've got talent, and you've got a lot of capital.
Yeah.
Duh. That's why they're successful, right? So for us, on the talent piece, look, recognize it. We don't have the depth that they do. That doesn't mean you can't be successful. ZirMed's a great example. The talent, I would argue the talent at ZirMed, and I've worked in a lot of I've worked in big company, big corporate America. The talent at ZirMed was very, very good. And I would put them up against, just about anybody in the market. So yes, you can do it. And eventually, if you have the right type of company, you attract the talent.
Totally.
Right? I mean, if you got a good company, people will show up, right? They're going to say, hey, I want to work for that company, right? And then go to the capital piece. So if you've got those first two elements, trust me, the capital will be there. It's going to show up. Yeah. Sequoia landed in Louisville and said, I want to invest in ZirMed.
Yeah. Yeah, okay? They didn't come
think
here
about, think about that for a second.
Look at horses, yeah.
Right?
Yeah.
They came here to look for the company. That's a great example. Yeah. So my view is when you're thinking about all this stuff, now I will say this, the mentality here is not as geared toward risk taking, right?
Yeah.
People tend to be a little more risk adverse. It's not the valley where they know they're going to fail on some things. And so failure here tends to be a little bit more of a, oh my gosh, you failed. It's like that's the death knell of your career, right? Obviously in Silicon Valley, that's not a, that's, do it again. That's a learning. That's a learning, right? So next time, now you know not to do that. Yeah. So you're going to do better the next time. So we're a little conservative here. So I do think that that's a little bit of the issue. But what I would ultimately say to most entrepreneurs is just understand what you are, right? Are you a lifestyle business or are you a business that actually can be a big business?
Yeah.
You know, can you be a $100 million revenue business? Can you be a multi-billion-dollar business? Or are you just, I can build a $10 million business and have a really good lifestyle and make a lot of money just off of that business?
Yeah.
That's okay. There's nothing wrong with that, but recognize what you are and recognize that an investor may not want to invest in that $10 million business because there's not enough upside.
Yep.
Right? So I think people have to recognize what they are. And then if you are one of those businesses that looks like a big business, the one thing advice I would give to entrepreneurs is be efficient, right? If you're going to take venture capital or any capital, take that dollar and turn it into 3 or 4 or 5, in terms of the revenue of the business. Don't take 5 million and generate 1 million of revenue. That's not a great ratio, right?
Yeah,
So the efficiency level that you can take dollars and turn it into multiple dollars, trust me, investors will line up, right? They're going to look at that and go, okay, I get it. You did that to here. Now I can go invest in that business. I'm willing to scale it, right?
Yep.
So I don't think there is no simple answer on that question. And it is all of those 3, but it's not, I don't buy that argument that there's no capital.
Well, and you simplified it even more when we spoke earlier. You said chicken or the egg. We don't have chicken or the egg yet. And that leads me to, the next question is, with ZirMed and, in Lexington, they had, the big exit. I just slipped my mind.
Where? I'm sorry. Indy?
In Lexington. No, in Lexington.
Extreme.
So HP. Flywheel. Out of those kind of exits, it builds momentum. So people leave that exit. They start their own company. Do you think that there's a sense of that you feel building here in Kentucky where, we've had maybe some exits, whether it's ZirMed or some others, people leaving El Toro or leaving Apris, do you feel like there's beginning to be a flywheel where these people get great experience in these big companies, whether they exit or not, they leave and do their own thing? Are you starting to see that?
Yeah, look, I think there's definitely some examples of it, right? So, the short answer is we just need more.
Yeah.
All right. But yes, there are very clear examples. So ZirMed's been a fantastic one. We sold it for $750 million. And I think I told you they transacted 2 years later, just like 6 months ago, at $2.3 billion, right? So they transacted again. The company continues to grow. So that's a big success story. There's a lot of good people over there. Occasionally those folks are going to roll out and maybe they go start their own thing. That would be great. You got Apris out here that is a $100 million plus revenue business, really, really well run, growing at a good clip. So you've got some El Toro is doing a fantastic job in terms of growing its revenue base. So you've got some good examples of companies as far as the ones that are coming out. So I'll give you a couple of examples. Behavior, Aaron Ganney came out.
E-Town?
Yes, he is.
Yeah.
Everybody
told me that.
All the great people. Evan, all the great people from are from E-Town.
Good.
You know that, right?
Yeah, I'm starting to learn.
Yeah. So Aaron was at Humana for a number of years, and he basically has the idea of doing virtual reality for behavioral modification in healthcare, right? So helping people with addictions, pain management, et cetera. So using VR as a tool to be able to do that from a therapy perspective. So he rolls out at Humana. Here's a guy that's a senior executive at Humana, rolls out and starts his own business. Fantastic, right? You want to see that happen. You're seeing it more and more.
Yeah.
But the reality is you just got to have more. And right? You just need more.
You had edited these notes that we love to send our guests, and a couple of other momentum things that you had mentioned is Microsoft came in town. You've got Endeavor, who we've heard great things about. Mm-hmm. We'll have to get them on soon. Mm-hmm. Healthcare CEO Council. So those are some other momentum things that you had mentioned. Yeah. So it's happening.
Yeah.
It's a slow process. Slow process.
So maybe we can talk about Poplar Ventures, but Poplar Ventures, we raised $22 million to invest in software technology companies, middle part of the country, early growth stage, right? Mm-hmm. So not trying not to put most of our capital work once the company's already achieved some success and a sense of what their business looks like. And that kind of fits with my investment philosophy and kind of how I want to go about that. So you got Poplar Ventures, you've got Access. Access Ventures is basically just announced a $15 million fund to invest in some earlier stage stuff. You've got Endeavor that's sitting there as a kind of a mentor relationship, and I've been a mentor with Endeavor for the last 5 years.
Andy had great things to say from SchoolVault.
Yeah, I mean, and their network is real. They have access to some of the most sophisticated folks, both on the investment side and on the industry side around the world, not just in the U.S. but around the world. So it's a fantastic network. So you've got that here that's leading, that's helping. Look, there's lots of good stuff going on. Again, I think this Microsoft AI thing, if we can get something really generating out of that, because the one thing that I see in a lot of other cities, if we're talking about trying to grow the ecosystem here, one thing I do see in a lot of other cities is typically there is a educational leader in that market that is driving technology or driving a lot of innovation.
Yeah.
Right. Columbus, Ohio State, Indy, you can go to Purdue even, right? So you go to Atlanta, there's all those markets have a university that's driving innovation. And I think, and I'm very excited about this whole Microsoft thing. Proof's in the pudding, but I'm excited about it because I do believe that AI, artificial intelligence, is kind of the next layer of technology on top of software and other things that is going to result in a tremendous amount of innovation and opportunity.
Yeah.
And I'm very excited to see U of L leaning into that. And I hope that turns into something very significant.
Yeah. I've been harping on AI for a while. I just feel like, we're in Kentucky, so people don't.
Do you think people understand what
That's
AI
my thing
is?
I'm harping on.
No way.
People are not talking about it enough.
What do you think AI is?
AI is essentially, building machines that can replicate, actions of what we do as humans.
Yeah.
Create,
That's it.
Yeah,
that's it.
That's it.
See,
that's the definition.
I think sometimes people get overwhelmed.
Yeah.
Like, oh my gosh, it's technology.
It's going to take over.
That's it.
Yeah.
That's all
I think people, we need more conversation around it, because if we don't, it's going to be here and we won't be prepared. And that's why that was one of Microsoft's big theses for coming is, Louisville is heavy industry, heavy manufacturing. These roles in the economy that can be disrupted by artificial intelligence. And one of the things that just bothers me, just going through UK and just looking at the education system, looking at just the general economy and society, we don't talk about it enough. It's not on the news. It's not, unless you're in the tech space, you hear about it a lot. But if you're outside of that, I think we have to start talking about it more, because it's going to lead to humanity. It's going to lead to real big, not necessarily problems, but shifts in the way that we have to, function as humans. And I just don't think people are thinking about it in the right way, or even thinking about it at all. Because again, I just don't want the day to come when it's already everywhere. People don't realize that Spotify, every app we use has it. Spotify. Yeah. So but there will be a time when businesses, a lot of the processes are just run by artificial intelligence, and people are going to be looking around where do I get a job? Well, there's going to be more jobs created, but at the same time, there's going to be a huge shift. I don't think we're ready. I don't think there's enough conversation. That's why I look at it. But
I'm an optimist.
Yeah. I'm optimistic.
I generally. I'm never going to be one of these folks that says, "Oh gosh, sky's falling."
Yeah.
And I get it. I understand people say, "Oh, they're worried about the jobs." The reality is, I think humans are pretty adaptable.
Yeah.
And yes, there's work to be done, and yes, we need to create the environment for people to be able to develop the right skills. But look. It's like with this coronavirus, I feel fundamentally optimistic that we will figure it out.
Yeah.
I don't look at that and go, gosh, the world's coming to an end, right?
Yeah.
So just anytime people, when they get negative or they get, I really do think that, the human race has proven time and time again that they have ingenuity and the ability to put their mind to it with the creativity that they need to be able to solve the world's problems.
Yeah. I mean, I'm not saying that bad things will happen. I'm not necessarily being pessimistic, but it's just happening so fast. And I don't see the education happening for people to, you said we're adaptable. But that's because we can learn. But it's happening so fast that I just feel like it's going to happen. And then we're going to sit here and have to catch up educational wise. Yeah. That's kind of what I'm afraid of. Yeah. But I think we'll do it. I think we'll be able to do it.
Yeah. So if you're going to get me, I got to be careful I don't want to get too close to politics, but if you think about schools like just K through 12, we're horrible about computer science, technology in general, and we're horrible on financial literacy.
Oh yeah. Oh, I harped on financial literacy to my dad for about an hour on the phone. We went to a talk by was it Steve Forbes, and he was talking about all this stuff. It was pretty much anti-Bernie and the way the younger generation tends to lean on towards politics. And I was like, I don't understand how anyone can feel this way. I don't want to get too political here, and I probably am already. But financial literacy is kind of what it comes down to in my head, is understanding the way money works.
What money comes from creating value, and I just don't think people realize that.
No. Yeah. So Now again, I'm gonna be at risk of getting political, but I will say this: I do not understand, and again, I'm an old person now, so I don't understand this this view that business is evil.
Yes,
I do not understand it. And here's why. What I would say to people is, if let's use Jeff Bezos as a perfect example, right?
People rip on him.
Here he is. Yeah. This is a guy that started a business and has continued to evolve, continued to innovate, continued to drive products and services to the market. And people would argue, I think, that the services that he's delivering are pretty valuable, right? So Amazon Prime is the simplest example.
Yes.
20 years ago, 10 years ago, I don't know, could you imagine that you could, actually, let me go back, let's go back 30 years because this didn't exist. Mm-hmm. 30 years ago, imagine that you could pick this up, scroll through something that gives you all the data in the world, and you could order a product and it shows up on your doorstep within hours or the next day at worst.
Yeah.
I mean, come on.
Yeah.
That happened in the last 30 years. And guess what? He's delivering value. You're paying for it.
Yeah, you're a consumer.
If you don't like it, don't pay for it.
But that's the thing. People can't go without it and they don't realize it. That's why, yeah.
But the part that drives me absolutely nuts is that they would, and here would be the argument back, well, he makes too much money, right? Yeah. And I would argue, well, if you're willing to pay for it and he's delivering you value, then it's not too much money.
Yeah. Yeah.
You're getting value from it.
Yep.
And so at what point, who decides that magically, oh, that's enough?
Yeah.
You don't get any more. I mean, who magically decides that?
Love this. I've been so upset about this recently. I'm glad somebody else was able to say that has way more, experience and reputation than I do, because I think that people just need to hear that. It's like, another thing is like, it's just about entrepreneurs. It's like people, when you rip on somebody that has value like that, you're ultimately ripping on the idea of being an entrepreneur. Like, they're taking huge risks to do that in the first place. And the risk follows, reward follows that risk. It's like,
absolutely.
Jeff Bezos is the best example. People like Elon Musk, they're the world's richest people because they're taking the world's biggest risks. And then out of that, they're able to intelligently build value for the world, whether it's Amazon Prime, AWS, which is one of the biggest services ever created that has led to so many other innovations. Rockets going to space and coming back and landing the size of a skyscraper. Those people should be the world's richest people, and they should be worth billions of dollars. I don't know why you'd ever argue against that. That's
and I think that people listen. I have tremendous. I value entrepreneurs greatly because I don't unless you've done it, unless you've tried to start a business, and to deal with the minutia of trying to build your business, raise capital, hire people,
go without pay for a period of time,
get people motivated. Unless you've done that, you just have no idea how hard that is to do.
Yeah.
And guess what? That's where the jobs come from, right? I mean, it's like if you don't have people that do that, you don't have jobs.
Jeff Bezos employs about 800,000 people. Yeah. So
look,
all right, we can end that. But one of the big learnings that we want to give the guest on this episode is we've got one of Kentucky's prime venture capitalists here, and I think a lot of people that are in the tech space, one of their things that they dream about is being a venture capitalist.
For sure.
Especially for me, it's like you want to start a company, and you eventually want to make enough money that you can help other people start companies and be successful. So when you talk about where you started, you had the ability to move from Nextel, come here, and get involved with Chrysalis. Just talk about that journey and where you might give people advice to just get started or begin working their way towards that path. Like, what are some things that you remember in your career that allowed you to do that?
Well,
other than capital, because that's an obvious one.
It's first thing I would say is it's not as glamorous as everybody thinks it is.
Mm-hmm.
I mean, it's great. I mean, one of the things I love about it, and I learned this really early on. I mean, if you're naturally curious, intellectually curious, and you see lots of different interesting businesses, it's fascinating, right? Yeah. It's like you get to kind of dig in on businesses. You get to meet a lot of interesting people. So it is fantastic from that perspective, but it's a lot of work.
Yeah.
Right. And what people don't realize is when you talk about doing venture investing, it's a long game, right? You invest in companies. Yeah. There's a lot of risk, right? Which weighs on you, right? So, I don't look at, from my perspective, I'm not a guy that likes to lose. So when I'm investing in a company, I really, really don't want to lose my investment.
Yeah.
I want that company to be successful. So I take it personally if it's not doing well. So, there's risk. It's a long cycle, and there's a lot of hard work, and you got to really help it. So the first thing I would say is, it is great if you like the intellectual curiosity and all that type of stuff, but it's a lot of work. So just be aware of that. Second thing I would say is the traditional paths for getting into venture capital are you're either starting early as an associate and then working your way up, or you go out and build your own business, or you become an entrepreneur, or you become part of an entrepreneurial team, and you have a successful exit or 2 or 3 or 4 or whatever the number is. And then because you have so much experience building and growing companies, you're now in a very good position to flip onto the other side and say, okay, I want to go invest in companies, and I have the experience to be able to help those entrepreneurs.
Like Reid Hoffman would be a prime example.
Yeah, I mean, there's a bunch of them.
There's
a bunch of them, and they tend to be, the good executives, entrepreneurial executives, tend to be pretty good VCs
because they can read and see a good entrepreneur because they are one.
Yeah. I mean, they can recognize that. So you can go one of those two ways. My general advice, because the first route is so hard, right? It's like a needle in a haystack to jump into that. My general bias, and again, there's always exceptions, and there's all people can, you can land in the right place at the right time. But my general advice is always go get some experience.
Yeah.
Go build something. Go be part of a team, and you don't even have to be the founder. just if you're in a growing company, like look, Nextel, I wasn't the founder of Nextel. I happened to get there at what I would call an opportune time, which was, I think I was at the headquarters. I might have been employee 10, somewhere in the 10 to 15 range.
Yeah.
Pretty early on at the corporate office, and that grew into what it did. So that experience, even though I wasn't the founder, I was part of the senior team pretty much my whole career. And that gave me visibility to a lot of things that I've seen that informs how I think about companies and how I try to help companies today. Mm-hmm. At Poplar Ventures, I'm trying to bring that experience to bear when I go invest in a company and give them the benefit of that and help them.
Yeah, that's great. And I just noticed this. It's amazing. I'd ask you a question at one of these high-level topics, and you'd hit every bullet point that we had here. So you obviously prepared very well. I just noticed that you hit like perfectly.
I haven't even looked at my notes.
I know, that's what I'm amazed by. I mean, look, it's like you got it all memorized. Before we get to the last question, which is our classical last question, have we not touched on anything you wanted to talk about today?
Well, I guess what I would say, just give you the commercial on Poplar Ventures.
Yes,
so,
do it.
The reason that I ultimately got to the point where I said I'm going to go raise my own fund was I had kind of evolved into focusing on software technology companies. I'd had some success. The ZirMed transaction occurs, and that's kind of, now I'm at a point where I'm like, okay, I could just keep doing that. I could just keep investing, when I find the right types of companies, do it on a one-off basis, bring in a few people. I've been bringing in people into my investments occasionally. I could keep doing that, or I could go raise a fund. And in the past, every time I thought about raising a fund, I didn't really want to do it because I thought it was a little bit too constraining. If you raise a fund, it's like, okay, I'm investing at this stage, this geography, this type of company. You're kind of boxed in. But the reality was, as I went through that process, I realized, look, I'm investing in software technology, recurring revenue-based companies. That's what I know. I'm 55. I'm not changing at this point. That's kind of what I know. So let's go invest in that. I'm here in Kentucky. I'm not going anywhere. I think the middle part of the country is prime for finding and developing technology-based companies. And the reason I say that is that, again, if you go back 30 years, I didn't have the networks. I didn't have cloud-based services. I didn't have all the things, the tools that are now available for anybody to develop a technology-based service. Yeah. You can leverage what everybody else is doing. That's the beauty. You got APIs into just about everything, right? So the landscape is set up that you can do it anywhere.
Remote work is growing fast.
Remote work is I cannot predict the future. Yeah. Right. But what I say is I try to recognize it when I see it. Mm-hmm. And remote work is a perfect example of that. You can see that that's going to continue to occur, coronavirus or not. You can see that is kind of the future of how things are going to get done, and it makes perfect sense. If people can be, as long as people can be productive, then it makes perfect sense that you don't have to have everybody in the same room all the time. So, you look at something like remote work, that's a big area, and you want to say, hey, let's find companies, again, back to that slipstream, get in the slipstream, right? And find big growth opportunities, find the right companies that get in that. So ultimately I said, all right, I'm going to go raise a fund because I know I want to do software technology. I know I want to do it in middle America. I know that there's opportunity there. And when I went about putting it together, I said, I'm going to go to, I'm not going to pension funds, at least initially, because I said, look, I just want to, somewhere in the $20, $25 million range. I want enough capital that I can go do enough transactions, but I don't want to get so big that, that I don't, that it turns into something bigger than I want it to be. I just want enough capital to be able to go do what I've been doing. Because I feel like I've been doing a pretty good job at it. I went to high net worth individuals, and all of whom are successful people in a variety of different industries. And I love that. I've got a network of 30 plus limited partners that have tremendous experience. And so much so that when I was putting the fund together, I said, I have an idea. I want to bring some of those, especially the ones that have software technology experience. I want to bring them on what I'm going to call as an investment advisory partner. Okay. So these are folks that have real direct experience in technology and software that can help me, evaluate companies potentially, but then also help those companies, right? So if you ask what's my value add for Poplar is you get me.
Yeah.
Some people might say that's a negative, but in this case, you get me. I'm not, when you send me an email, I'm responding. You send me a text, I'm responding. You call me, I'm responding. So that is the one thing I've learned that from people through my career too. Fast response. Mm-hmm. It is so annoying when somebody tries to get to you, especially somebody you know, and you don't respond. Mm-hmm. So if I could tell young people one thing, respond, right? Just quick, get back, right? It's almost disrespectful when you don't do it.
What's long? What do you consider, real quick, just to put a number on it? Any kind of like what crosses the border of being too long?
Look, I try, and again, you can't always do it because you got stuff going on, and you got it may take. I literally try to respond within the day.
Yeah. Okay.
And you don't have to respond right away, but but get back to folks. Right? It's common courtesy.
I 100% agree with you. Yeah.
So what I did is I out of that group of limited partners, I put together a group of investment advisory partners, and these are folks like Mike Davis, the CEO of Appriss, who basically has been with that company from the beginning, and it's turned that into a fantastic company here in Louisville. Chris Joseph, who's the CEO of Enablon, another $100 million plus SaaS business. He's based out of Chicago. Got to know him back in my first Chicago days. From the ZirMed side, Jim Lacey, who is the former CFO. He's now the president and COO at Collective Medical out in Salt Lake City, but he was the CFO at ZirMed, very involved in all the growth of that business and the strategy side. Chris Schremser, who's the CTO over at ZirMed, now Waystar. He helps me from a technology perspective. He's running the whole technology organization in a SaaS company. I've got a couple folks here locally that are, Vic Chadha, Greg Langdon. These are guys that I would argue around here are probably as clued in and as intelligent about early stage businesses in terms of advising them and mentoring them and helping them as anybody in the state, right? So they're involved. And then I've got a gentleman by the name of Doug Smith, also from E-Town, who was maybe a year behind me in high school, who's been working at Microsoft for 25 years. He runs cloud services for North America for Microsoft. So these are people that I have that are part of my team, as part of my investor base, and that's what I try to bring to bear to my companies. I try to, give them my experience in terms of what I've learned over the years. I try to obviously help them in, their individual companies. Help them with talent attraction, certainly help them with strategically. If you get to the corporate development side, I know that side pretty well. But then bringing all these other folks to bear. And I think that, if at the end of the day, it is about, trying to figure out a way to help these companies. I'm not a futurist. I don't think I know better than anybody else. I just try to identify what I think are unique opportunities and then help those businesses grow and be successful.
Yeah, that's great. I'm glad you plugged that. So last question. We ask everybody this. Forward-looking statement. Where do you see Louisville being in the next few years? It's high pressure question, but in your mind, what do you see happening here? You probably put several pieces of it while you've been talking together, but what's the one or two sentence, maybe short paragraph of where you see this going?
Yeah, look, I'm short answer is I have no idea. But what I would say is that we have good momentum. You know, we talked about earlier some of the different elements that are starting to kind of fall into place. And there is no magic bullet. It is basically going to come down to just doing more and just continuing to iterate. There's no, just a lot of hard work, I think, is what's going to ultimately happen.
That's a good realistic answer.
I don't have the magic answer there. I really do. It is just a matter of, look, more is better. So more capital. I don't need to be the only source of capital. I raised $22 million, and that's one of the larger venture funds in the state of Kentucky, right?
Yeah.
Which is ridiculous, but it is. Yeah. So, but guess what? Access comes along. They put some capital to work. I hope there's more. I hope there's more folks that bring capital to bear, right? And I hope that there's more companies I hope that companies merge, come out of ZirMed, Waystar, or Apris, or executives, or El Toro. Executives come out of there, they form companies, and then they start growing. And that's how it happens. You just have to, it's one company at a time, and just go after it.